Well, hello everyone. John Hutchinson with Traders Reserve. Welcome back to Filthy Rich Dirt Poor for Tuesday, September 20th, and our full week sessions on how to beat a bear market. Yesterday, we talked about where we are now and a wide range of topics. And then I introduced you to the stack, a new concept that I'll be slowly rolling out with you all week. And today I want to talk about the S&P 500's projections for next year and how that fits with the things that I'll be talking about as it relates to the stack, but also to give you some guidelines on and for your trading as it is right now. And I feel like there are too many moving pieces, and it makes it maybe confusing to read the market and have a general sense on, is the market going to go up? Is the market going to go down? I mean, is the market just going to go down, 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 down? Right? It's like, how do we find a bottom? How do we find stability in the market so we can have more confidence in our trading? And that's going to be my objective today with the S&P 500 valuation targets, because what I'm finding interesting right now is it's if you have like one of those Ziploc bags, and I admit it's a stupid analogy, but it's the one that came to mind, so bear with me for a minute. You know those Ziploc bags where you zip one way, you zip back the other way to open and close, right? That's kind of feels like what the market's doing right now. Right? It's moving from a valuation of 16 times forward earnings to 17 to 18, and then back to 17, back to 16. And you can, as we go through the numbers here and the chart, you can see what I mean by that. And I think that's what makes it frustrating for you, even though most of you, I think, at least in our services, are having fairly good experiences right now, meaning we are not getting kicked in the teeth. Not to say that we haven't had trades that have gone wrong or that we have not had losing trades, but I think that we've been far more stable than the overall stock market or most other traders out there. And part of that is because we really do have a handle on where we're trading for right now, and we're not trying to predict future moves, right? We're not trying to guess where the market's going to go. So we're trying to play the hands that we're dealt each week or each month. And so far, we've been playing them well. But for you and your trading, some things that I wanted to talk about today as it relates to this valuation table is to use this as a general guide for where is the market? Is the market at a top? Is the market at a bottom? Or, like we more or less are right now, is it trading in the middle? And if you look at the 2023 earnings per share for the S&P 500 right now are estimated at $240 a share. Personally, I think that's high. We haven't even finished 2022, and although earnings for the S&P 500 have been, for the most part, in line with expectations in the first two quarters, we still have 2 quarters to go, and we don't really know whether or not there's going to be a recession, right? It's like storm clouds on the horizon, and you're like, when's the storm going to hit, and when can it just rain so we get it over with? And it's like the economic data doesn't suggest recession, but all of the other metrics keep saying, well, there's a recession coming. But if we look at these numbers, what this tells me is that the stock market is trading in a fair market value range. We have the low across the top line of the table. I try to use my little fancy pen here. At the top here of a low of 3,600, which we hit in June, and a high of 4,320, which we hit right over here on the right side of the table in the middle of August. And so the market is trading in a range that it already knows. It's already staked out this territory. which is in part why the upper line at the 4,300 level is resistance, and is the market, as all of the other things and other factors that we talked about yesterday, and we'll talk about some of them more the rest of the week, as those just keep not improving, it makes it more difficult for the market to break out. And it also, to a degree, makes it harder for the market to establish a bottom. Well, right now, I'd say we have very strong support at the 3,900 level. Mind you, I'm telling you this on Monday, between Monday and Tuesday, September 19th and 20th, a day ahead of the Federal Reserve. So the Fed could change a whole lot of things, and we'll talk about that in tomorrow's video. But for the moment, the most important thing to remember is this top line right now is where we are, where we're trading. This is what the stock market is doing right now, and you can see it, right? You can say 3,600, 4,300. I can see it. So if the market channels up like this, you can certainly anticipate that will be a line of resistance, and that may or may not then send the market back down, right? So we can plan for that kind of eventuality. But these two EPS levels, I don't want a box, I just wanted a line, sorry. These two levels here, 230 and 220, are if conditions begin to worsen. So I include them here because it helps to stake out where could the other bottom potentially be. And the reality is that unless conditions improve dramatically, the S&P 500 isn't going to trade at 19, 20, or 21 times forward earnings. Historically, last year, the S&P at one point was trading at well over 21 times forward earnings. So you could see how much lower what the market's willing to pay is now compared to last year. So we have a top. We know on the charts, technically speaking, the 4320 is going to be the high. And if this is sort of like a worst case scenario here at 220, if conditions worsen in Q1, Q2 of next year, the market may have a bottom that's another 10% lower than this number here, 3,600. Right, so that gives us some working numbers, and the way to trade this is twofold. And I want to make it clear that this is one of the best years to be trying new things, because if you can learn to make money when the stock market is doing this, when it's sideways or when it's sharply down at certain periods of time, like here in the middle of, from the beginning of April through the middle of May, and even sharply here from late May down to the early to mid part of June. Like when you can make money in those periods, that's when you can have more confidence in what you're doing. And as we go through the rest of this week, I will give you some more ideas on steps and things that you can take to do that. But what we're just seeing right now is the red arrow on the far right side. The S&P 500 is marking out a clear support boundary at 3,900. If anything changes in the next few days with the Fed, or in the next few weeks with upcoming, we're going to have all of our economic data numbers later this month. I don't think they'll have huge impact, but you'll have CPI again at the beginning of October. You'll have the jobs report in October, and we have earnings beginning in October. And earnings starts to become a little bit of a concern because of FedEx, and they're cutting the cut forward guidance so drastically in their earnings report for last Friday. That's what we have to watch out for. And Q3 is the point where you need to, for businesses, stocks that you own, not necessarily, not things that you're trading, not stocks that you're trading, stocks that you own in your portfolio. Q3 is when you want to start paying attention to their forward guidance in their earnings reports, because that will be what has an impact here on 2023 earnings per share for the S&P 500. If we start to see more large corporations do what FedEx just did, then those EPS expectations will begin to change. And as they change, the tradable levels in the S&P 500, and by extension the Dow, the NASDAQ, and the Russell, will also have to change. So a simple exercise, and if you can build this in an Excel spreadsheet and keep track of this, right? You can just Google, Google earnings per share, S&P 500. You'll get the expected earnings per share, and then you can keep track of the range of 15 times to 18 times forward earnings. So all you're doing is multiplying 240 by 15, 16, 17, or 18 to get these levels. And what that helps you know is when we're at a top, when we're in the middle, or when we're at a bottom. And then that can at least give you some directionality in your trading. And really what it does for me, though, the most important thing is it helps me see the general mood of the market. And that mood is still this way right now. Right? We don't have clarity. We don't have stability. And we need both of those things. Until we get them, the market will continue to trade in these ranges. We'll trade down. We'll trade back up. It's like watching a squirrel cross the road. And it will be like that, I think, for the next several weeks. But then with things, I think, will start to get better. So I wanted to take a walk through this idea of the valuation targets, because this gives you a sense of where the market will trade, not necessarily for next year, but ahead of next year. As a reminder, usually around July each year, you start to see the market pricing in the forward expectations for the next year's earnings. So the market's typically working 6 to 18 months in advance. So these levels that we're seeing now are where that's the value of the market, call it 6 months from now. So heading into March, April of next year, that's what the market's willing to pay in advance for stocks for next year. So as these numbers, as these valuations change, then that obviously will change where the market trades. To that end, one of the fun things that we've been doing is trying to figure out how we exit a bear market. What are the things that have to change for us to get stability and to get a clear direction in the markets and even in individual stocks or ETFs? And we've narrowed it down to 5 things. And I built a little table here, a new scoreboard, and I'll just walk briefly through these because I'm covering some of these topics later in the week. But for the time being, the Fed, inflation, Dow theory, GDP, and yield curve. If you can follow those 5 things, or if you can let us follow them for you, that I think begins to become a guide for when the market shifts from bearish to bullish. I don't know when it will happen, but I do believe these 5 things will be the 5 things that have to change in the way that I've laid them out here. So the first thing is the Fed has to switch from being hawkish to being neutral. Hasn't happened yet. Inflation has to change from being elevated to declining, not back to normal. Important distinction there. And again, I'll cover that a little later this week when I talk about inflation. Dow theory has to shift from bearish to bullish. And we'll talk about that next week. GDP has to remain in growth, has to remain positive. It can't change to recession. So that one in the table is a little bit different because right now I would call it yellow based on Q1, Q2, but we have not been declared to be in a recession. Consumer spending is still higher. So we don't meet any of the real definitions of being in a recession at the present time. And then the yield curve, which is now almost back to its absolute low, and it's a multi-decade low. So it's currently negative. The yield curve, the 10-2 spread, needs to change to a positive number. So it has a ways to go. So those 5 things, and one can help the other, but as these 5 things begin to shift out of their current statuses into new statuses, or for GDP maintaining a status, that's where I think we start to see the end of this bear market. So between this scoreboard and these valuation targets, this is how I think you can best set yourself up. For example, if you're putting more capital on the sidelines because you're worried about the volatility in the marketplace, just these little steps can help you decide that this is a point in time where I can put more money back to work in the market, as an example. So more to come the rest of this week, but this is a new scoreboard we'll start publishing in probably each month in Filthy Rich Dirt Poor, and we will update it each month goes by. And when one of these turns green, that'll be a good sign, right? So red, bad; good; green, good. We'll keep it pretty simple. So if any or several of these begin to change green, that'll be the point where I think we can say this is where we've have a floor in the market, we're moving higher, or there's stability in the market, economic and all other conditions are improving, sort of like an all clear signal. So that's going to be our new scoreboard for the next 6 months. So for the next quarter, Q4 22, and for the first quarter of 2023. And I think by the time we get to the Christmas, New Year's period, we should have a really a much better outlook for Q2 and Q3 of next year. So as I said, light at the end of the tunnel. As I said yesterday, there's a light at the end of the tunnel. We're almost at the end of the tunnel. The next 6 months, I think, gives us more clarity